There's a high probability that the Fed is finally done hiking rates, which in turn could end up helping the housing market. And that's exactly what we're going to explain in today's video. We're going to go over the latest data that's impacting the Fed's decision to likely hold off on hiking rates any further, and what that means for you as a buyer or seller as we move into the 2024 housing market. So this past week, the Fed held the rate steady with a unanimous agreement to hold the key federal funds rate at a target range between 5.25% and 5.5%. Now, this is the second consecutive meeting that the Fed has decided not to raise rates. And adding to that, Fed Chair Jerome Powell came out with some really important statements, saying given how far we've come, the Fed needs to proceed carefully going forward. On top of that, saying the risk of inflation has gotten more two-sided. And lastly, saying the Fed hasn't made a decision on next month's move, which in translation mean that the Fed rate hikes are likely over. Now, this is the second consecutive meeting that they haven't hiked, and the most dovish that Fed Chair Jerome Powell has been since he started hiking rates, which in turn likely means that the cycle is over. Now, we all know that the committee is going to continue to be data dependent. So barring any unforeseen major bullish economic reports, it's safe to assume that rate cuts will likely start sometime in Q2 or Q3 of 2024. In fact, the updated Fed futures chart shows that rate cuts will start in June of 2024, which is 3 months ahead from last month's September prediction from the Fed. So why all of a sudden this big change in the Fed's stance when just a couple of months ago they were predicting at least one more rate hike in 2023? Well, one of the main reasons is that we're starting to see inflation ease. We're starting to see it moderate, with the Fed's key inflation gauge only rising 0.3% in September, with core PCE sitting at 3.7%, which is 1/10 lower than it was in August. So why does the Fed give so much weight to core PCE? Well, the primary reason is because they believe it gives a better snapshot of where prices are headed over the long term. And if you remember, core CE peaked back in early 2022, sitting at 5.6%, and has primarily been on a downward trek ever since that point. And while it still is above the Fed's 2% target, it does show that inflation is starting to ease, likely due to all the Fed rate increases along with a slowing economy. And that's exactly what the Fed wants to see. In fact, this past week, we saw the Atlanta Fed GDP cut its Q4 forecast from 2.3% to 1.2%, which in turn shows that the economy is slowing. And on top of that, we're starting to see some change in one of the other things that the Fed pays a lot of attention to, and that's the jobs market. But before we dive into jobs, I want to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated on everything that the Fed is doing, mortgage rates, housing, along with finance, do me a favor and hit that subscribe button. U.S. payrolls increased by 150,000 jobs in October, which was 20,000 less than the consensus forecast of 170,000 jobs. But one of the key things to note here is that was a sharp decline from the 297,000 jobs that we saw back in September. Along with that, we saw the unemployment rate rise to the highest level that we've seen since 2022, sitting at 3.9%. In addition to that, we actually saw the ADP employment numbers also come in less than expected. Now, why are there two different job reports? Well, ADP only looks at the private sector. They don't take government jobs into account. But either way, we saw the number come in at 113,000 jobs, which was well below the 150,000 jobs that were forecasted. Now, this is the third consecutive miss for ADP, where it looks like the numbers will continue to trend lower. And one last thing on the jobs front is we saw job openings. The JOLTS number actually come in a little bit higher than expected, sitting at 9.553 million jobs. Now, this was a little bit higher than the estimate at 9.25 million, but still below 10 million jobs, which in turn shows that we still have a cooler labor market. Now, I know a lot of people watch this video and go, Jeb, there's 9.553 million jobs available. Isn't that a bad thing? Well, it actually depends on how you look at it. If you're somebody out there looking for a job, it shows that there are a lot of jobs available. But when it comes to how the Fed looks at it, the Fed doesn't like to see a lot of available jobs, because the more jobs that are available out there, that means that there's a high likelihood that employers will likely have to pay more to find good help. Therefore, that increases wages and in turn could lead to wage inflation, taking those inflation numbers back higher. So what the Fed wants to see is actually a lower number of jobs actually available out there in the market, which means that less employers are out there trying to find help. But for the moment, as long as we stay under the 10 million number, then the Fed is probably going to be happy with those numbers. But while we're talking about the JOLTS number, one thing that the Fed does pay attention to is the number of quits. How many people are actually quitting their job? And this number came came in a little bit better than expected at 3.661 million versus 3.663 million. Now this number came in at 2.3% for the third consecutive month and equaled the same rate back from 2019, which means if the quits rate can hold steady from here, that suggests that workers still have leverage out there in the market and that wage growth may actually continue to slow. So how will this actually help the housing market? Because earlier in the video, I said that the Fed stopping the rate hikes might actually help housing. Well, the idea here is that all the data shows that the economy is starting to slow. And as the economy slows, the Fed is going to continue to get more dovish, which means we're not likely to see any rate hikes going forward, meaning that this latest cycle is over. But with that said, we're not likely to see any Fed cuts, any pivots until sometime in mid-2024, unless you see the economic data get way worse, which at the moment, it doesn't look like that's going to happen. But here's the thing, the market is starting to read into the Fed, starting to read into the data in a little bit more detail. They're starting to read between the lines, if you will, which is one of the things that the Fed has actually been trying to avoid. The Fed has really kept their stance because they don't want to lead the market to believe that they're going to pause, that they're going to pivot, because as soon as they lead the market to believe that, guess what's going to happen? People are going to front load the market. They're going to jump back in the market, in turn likely spending money. Businesses are going to start to spend money because if the Fed leads them to believe things are going to be less expensive in the future, that likely means people are going to start taking advantage of it sooner than later. So they don't want that to happen. In fact, that's one of the reasons that Fed Chair Powell doesn't really get into detail about the future. They just say, hey, we're looking at the data. This is where we are. They don't talk about what they're planning to do. But as I mentioned, the market's starting to read in between that a little bit. And with this latest data over the last week, what we saw was the 10-year pull back a little bit. And on top of that, we saw mortgage rates have a slight retreat from 23-year highs. Now, I know that clip said mortgage rates sitting at 7.76%, but as of this video, rates are actually down to somewhere around 7.5%. And there's a good chance that you might see mortgage rates bounce somewhere between 7 and 7.5. Now, with that, that doesn't mean mortgage rates are automatically headed lower. It just means you see a little bit of reprieve out there. You see a little bit of improvement. Now with that, there's a really good chance that you see volatility in the mortgage rate market, which means rates are going to come down a little bit, then they're probably going to go up a little bit, come down, give back, so on and so forth. This is completely normal. Rates aren't just going to come down in a straight shot. It's going to be a slow grind lower. But with that, I can tell you, as the economy slows, rates are going to improve, which in turn is going to improve housing affordability. Now, I know a lot of people out there are under the belief that as mortgage rates come down, that's likely going to lead to much higher house prices. Now, I personally don't think that's going to happen. But at the same time, I also don't believe that it's going to lead to much lower housing prices either. House prices just jumped for the 7th straight month, taking them to a record high in August. And that's largely due to the way they calculate the data, but also due to the fact that there's just not a lot of inventory out there in the market. And because there's so many mortgages out there under 4%, essentially handcuffing homeowners, you're not likely going to see a huge increase in inventory even if mortgage rates move down a little bit. In fact, I think you need to see rates closer to 5% to really unlock any real inventory out there in the market. But with that, you have to keep in mind that most people putting their home on the market for sale are also taking one off the market. So there's no real net increase in inventory. In fact, the only real way to increase inventory is to have somebody put a home on the market that is planning to rent and not buy something else, and or home builders building more homes. And at the moment, we know that home builders are feeling the weight of higher mortgage rates, with PulteGroup actually seeing fewer closings out there in the market because they can only buy rates down so far. But as mortgage rates improve, home builders will be able to buy rates down to a level where buyers can make it make sense, likely picking up sales in that department, but that's not going to help the inventory front. And that's largely why I believe that mortgage rates coming down isn't going to shoot house prices a lot higher. At the moment, housing affordability is still sitting at record lows, so there's just less people out there able to buy homes. In fact, every 1% that mortgage rates go up or down, it affects nearly 5 million people being able to buy or not be able to buy a home. So if rates were to decrease 1%, taking them from 7.5% to 6.5%, that essentially means you have 5 million more buyers that are able to buy a home. So that does add to competition out there in the market. But typically what happens in those scenarios is those buyers that were ready to buy out there in the market looking, it benefits those buyers. The buyers that have been sitting on the sidelines waiting for things to come down, those buyers typically aren't quite ready yet because many of them believe that things will continue to improve even further, that rates will continue to go down even further benefiting their situation. And while that could happen, there's also a chance that it doesn't happen and those people just stay put. As things start to decrease, the emotions start to play into the process, and some of those people will never end up buying homes just because they're always looking for a better scenario. But if there's one thing I want you to take away from this video, is that rates are likely to improve. It's just not likely to happen in a straight line. It's going to be a grind lower, and it's likely going to take several months, possibly even a year and a half before you see a big improvement in interest rates. And with that, I don't believe there's a huge rush to go out and buy a home today. If you can find the right home for you and your family, you're comfortable with the payment, you have a longer term time horizon, then go for it, because I do believe there's an opportunity at some point in the future to take advantage of lower rates. Now, again, not going to happen tomorrow, likely going to take some time. And by buying that home now, you've essentially locked in the worst case scenario, because as mortgage rates come down, it's going to stabilize house prices even further. But on the flip side, if you're waiting for house prices to get lower, for rates to get lower, for everything to improve all on the same front to make it much more affordable, I also don't believe that's going to happen either. You're likely to see one of the three legs of the stool improve to improve housing affordability, those legs of the stool being house prices, interest rates, or wages, but I don't think you're going to see all three at the same time. So in the meantime, focus on the things that you can control so that you can put yourself in the best position so that when you are ready to buy a house, you're not starting from zero.